Good afternoon and welcome to Bulls, Bears, and the Belt. Thank you for joining us. Today we are strapping in for, well, the kind of deep dive that really makes you question what's driving things in these financial markets. We're looking at Friday, October 24th, 2025. A day the U.S. markets didn't just, rally. They absolutely exploded. Historic highs, uncharted territory, all based on what seems like, well, maybe not much pretext at all.
It really wasn't just a rally, was it? It felt more like a huge psychological shift, like a collective sigh of relief that turned into, broad-based euphoria. It just wiped away weeks of anxiety almost instantly.
And the numbers are big. The Dow Jones Industrial Average jumped over 400 points, closed at, an estimated 43,150? A new historic peak.
That's right. And crucially, like you said, it wasn't just a few mega caps doing the lifting. This was broad.
Yeah, the S&P 500, the US 500 benchmark, it climbed nearly a full percent, 0.97% to close at 6,804. It even hit 6,808 and changed during the day.
But the real engine, the real enthusiasm was definitely in tech. The NASDAQ composite led the whole pack, rising a blistering 1.03%.
So our mission today, for you listening, is to peel back the layers here. We need to get at two core questions. First, what caused this massive record-setting reaction?
And second, what does this reaction, this, instantaneous rush back into optimism, tell us about the health and, maybe more importantly, the fragility and the risk profile of the market right now?
We're really trying to analyze that gap, aren't we? Between what the actual data says versus what the market seems to be choosing to believe.
Exactly. It's a fascinating dynamic.
Okay, let's unpack the engine then. Because the source of all this sound and fury was basically one single piece of macro data. And the market had been waiting for this one, partly because that 24-day government shutdown created what we called a huge data vacuum, right?
Precisely. Investors were starved for clarity, so the main catalyst was the September Consumer Price Index report, the CPI.
And the euphoria. It came from what was, objectively, a tiny miss.
Tiny is the word. The report showed year-over-year inflation rising 3.0%. Okay, so the consensus forecast was for 3.1%. It came in just 0.1% below that.
0.1% lower than expected.
Yep, and month-over-month was similar. Came in at plus 0.3%, just a hair under the expected, plus 0.4%.
That difference, mathematically, shouldn't spark a 400-point Dow surge and new S&P highs. It just shouldn't.
But this is where it gets really interesting, as you said. The market immediately interpreted this minuscule miss as some kind of definitive green light, a signal that the Fed could and would pivot away from its tight policy stance.
So that reaction itself tells a story.
It tells a huge story. It basically proves the market is now aggressively, almost desperately priced for perfection. It's not reacting to the level of inflation anymore. Let's be clear. 3.0% is still way above the Fed's 2% target. It's 50% higher.
Right.
Instead, it's reacting purely to the direction, the rate of change.
Right.
It's seizing on the smallest hint of dovishness to justify, a rapid re-rating of assets.
So it confirms investors were just looking for any excuse, any justification to believe the rate hikes are done.
Desperately seeking it. And let's pause on that 3.0% number. Historically, that would be high. That would probably signal more tightening needed.
Absolutely.
But in the context of the last few years, after seeing much higher prints, 3.0%, especially when it misses expectations, even slightly feels like a huge psychological win for the market. It fits the disinflation narrative.
It reinforces the idea that inflation is contained, even if it's not totally defeated yet.
Exactly. The narrative just flipped on a dime from Fed needs to keep tightening to Fed's done, cuts are coming. And this kind of hair trigger reaction suggests real fragility. Investors were coiled tight during that data vacuum.
And the moment they got even a sliver of justification,
bang, they stampeded back into risk. That kind of emotional volatility is often a sign of an overextended market.
and the immediate fallout, the quantifiable consequence, expectations for the upcoming FOMC meeting, October 29th.
Completely solidified. The market is now fully pricing in a 25 basis point rate cut. That would be the second cut this year, remember, after the September one brought the rate down to that 4.00%, 4.25% range.
So the market's basically built its entire outlook for the next 6 months, maybe longer, on the assumption that this cut is a done deal.
And that right there is the definition of being priced for perfection. If the Fed delivers, the market just shrugs, says told you so, maybe drifts higher. But if the Fed pauses or delivers that cut but sounds hawkish,
The disappointment would be massive, because that expectation is now baked into valuations, especially for those growth stocks.
seismic is the word I'd use.
Okay, so we understand the trigger, that slight CPI miss fueling Fed pivot hopes. Now let's dissect the market's reaction on the day itself. Perform an anatomical review, if you will. Where did the money flow? Because that sector rotation, it's like a blueprint for the Fed pivot trade playing out.
It was a textbook aggressive risk-on rotation, and participation, like we touched on, was broad. It wasn't just the giants. Look beyond the Dow and S&P. The small-cap Russell 2000 index also had a strong day, up 0.9%, nearly matching the big guys.
Why is the Russell 2000's performance particularly telling here? What does that signal?
Well, small-cap companies, they're typically more focused on the domestic economy. And crucially, they're far more sensitive to borrowing costs than, say, Apple or Microsoft. They often have more debt, rely more on bank loans, or need to refinance debt at whatever the current rate is.
So when rate expectations fall,
It's a huge relief for them. It dramatically lowers the perceived future borrowing costs, makes their balance sheets look healthier almost overnight. So seeing the Russell jump 0.9% signals that this optimism about Fed easing is spreading beyond just big tech to the real engine of the domestic economy. It suggests confidence in smaller businesses surviving, maybe thriving, if rates come down.
makes perfect sense. They get hit hardest by high rates, so they benefit most from the promise of cuts.
Okay, but looking deeper, at the sector level, we saw that classic barbell effect, and it was intense. On one side, the clear winners, technology and semiconductors, they just rocketed higher.
Absolute textbook. It's almost a mechanical response to falling interest rate expectations.
Yeah.
We need to explain the physics here for everyone. The yield on the 10-year U.S. Treasury note, that's basically the market's fundamental discount rate.
Right.
When that 10-year yield falls, the net present value, or NPV, of future cash flows goes up.
Okay, walk us through that link again. Why does it boost tech so much more than, say, an oil company like Exxon?
Think about when these companies expect to make their big profits. For a growth company, like a chip designer riding the AI wave, a huge chunk of their value is tied to profits they hope to generate 5, 10, even 15 years from now.
Further out in the future. Exactly. Those distant future profits have to be discounted back to what they're worth today. And the discount rate you use is heavily influenced by that 10-year Treasury yield. So if that yield drops, like it did on Friday, dipping under 4%, those future earnings are suddenly worth significantly more today. They're discounted less aggressively.
That's the long-duration asset concept. Their value is weighted towards the future.
Precisely. And the stock moves proved the mechanics. Advanced Micro Devices, NMD, surged 6.5%, hit a new all-time high, $243.11. NVIDIA, central to AI, rallied 4.2%. Even the giants like Microsoft, up 2.4%, and Apple, up 2.6%, got a significant lift. The bond market basically handed them a mathematical justification for higher valuations, instantly.
Okay, so that's one end of the barbell money flooding into high-growth, long-duration assets whose future earnings look better with lower rates. What about the other end? Money flowed out of what?
Out of the traditional safe havens and value sectors, it was a fundamental repricing, a shift away from defensives. This signals investors suddenly felt less need to hedge against inflation or a potential recession.
So where did we see the pain?
Energy was the biggest loser. ExxonMobil finished down 1.8%, Chevron dropped 1.6%. Then you look at classic defensive plays. Healthcare, Pfizer down 1.4%. Consumer staples, Coca-Cola down 1.2%, all in the red.
So capital literally moved out of companies valued for their current stable cash flow and safety.
And piled into higher risk, higher reward growth stories that depend much more on future conditions being favorable. It's a dramatic shift in risk appetite playing out in real time.
And you can trace this whole rotation mathematically back to the bond market action.
Directly. The 10-year U.S. Treasury yield, as we mentioned, immediately eased to 3.99%. It even dipped to 3.98% intraday. That benchmark risk-free rate, it's fallen about 0.17 percentage points just over the past month. That decline is the ultimate green light for this kind of move.
The fact that stocks, S&P 500, and bonds, treasuries, rallied together
Confirms it. That's the classic Fed pivot trade in full swing. Lower yields justify higher stock multiples, especially for growth.
Okay, we've got the euphoria, we've mapped the capital flows, but now let's give it ourselves. Let's look at the deep contradictions here, because this rally feels unstable. The market seemed to be reading things very selectively on Friday.
Willfully blind, almost, to anything that didn't fit the happy narrative. While everyone was cheering the lagging CPI report, remember, that tells us about inflation back in September, they simultaneously ignored a key forward-looking signal released the very same day.
You mean the flash US PMI survey?
Yeah.
The Purchasing Managers Index, what did that show?
It showed a surprisingly strong start to the fourth quarter. U.S. business activity growth actually accelerated in October, reached the second fastest pace all year, apparently.
And PMI measures things like new orders, production plans. It looks forward.
Exactly. Strong PMI usually implies solid underlying economic demand, and solid demand tends to fuel inflation, especially wage inflation, which is the stickiest kind.
So that presents a huge paradox for you, the listener, doesn't it? Is the market just focusing on what it wants to see, the cooling inflation in the rearview mirror via CPI?
And ignoring the signposts right in front of it, like the PMI suggesting continued economic strength. Because that strength, that complicates the whole Fed pivot narrative considerably.
Absolutely. If the economy is still running hot, the Fed might be less inclined to cut rates aggressively.
Or at all, potentially. The market chose the dovish interpretation of CPI over the potentially hawkish signal from PMI. And that selectivity, that has big implications for market anxiety, or rather, the lack of it, as measured by the VIX.
Right, the VIX, the fear gauge. It actually fell, didn't it? Dropped 1.27% to close around 17.08. Pretty calm.
Deceptively calm, because that calm close completely ignored the real anxiety we saw earlier in the week. The VIX had briefly spiked to its highest level since April.
Driven by what? Geopolitics, trade worries?
Yeah, anxieties over trade policy, lingering concerns about regional bank stability, maybe some geopolitical jitters too. Those fears had built up.
Meaning investors were likely hedged.
Massively hedged is the sense. People had bought protection, shorted volatility futures. So when that slightly cooler CPI number hit, it wasn't just a signal to buy stocks. It acted as a huge VIX crush event.
Explain that. What does that mean in practice?
It likely triggered a powerful programmatic short squeeze in the volatility markets. All those investors betting on fear rising were suddenly wrong-footed. They had to scramble to buy back their short volatility positions to cut losses.
And buying back volatility shorts pushes volatility down.
Exactly. And the capital freed up from unwinding those hedges. It likely poured straight back into equities, adding fuel to the fire. So the unwinding of fear itself acted as a massive accelerant, pushing the indices even higher, perhaps beyond what the CPI news alone really justified.
So it wasn't just organic buying, it was also forced buying from the unwinding of hedges. A feedback loop.
A powerful one, but maybe the most alarming sign of this potentially being late-stage euphoria isn't the institutional VIX crush, it's what was happening underneath the surface with the retail crowd.
Ah, the dual track market you mentioned. What do the volume numbers tell us?
This is critical. We need to look at the most active list for the day. Yes, you had high-quality macro-driven names like NVIDIA and Microsoft rallying for fundamental reasons tied to rates, but simultaneously you had this massive parallel speculative wave in, frankly, high-risk, low-priced stocks.
The numbers are kind of eye-watering. Beyond Meat, BYND, traded 1.6 billion shares, and YAI Inc., YIAI, another super volatile name, traded 1.5 billion shares. These aren't companies benefiting directly from lower discount rates in the same way.
No, this is pure speculation. This isn't careful institutional money allocating based on a new Fed cycle belief. This looks like a highly leveraged, almost frenzied retail chase in what some might call junk names.
And this dual track surge where you have high-quality growth and high-risk speculative names both soaring on huge volume.
That pattern is often seen as characteristic of late-stage market euphoria. It suggests a market that's becoming overextended, maybe driven more by FOMO, fear of missing out, and pure sentiment, rather than just fundamentals.
I remember seeing that kind of parallel action back in late 99, early 2000, when everyone's chasing everything, quality or not. It feels like a sign of vulnerability, like the market structure is becoming unstable.
It certainly makes it more vulnerable to a sharp reversal if the narrative shifts. It's like adding rocket fuel to a potentially shaky foundation. And if we look beyond stocks and bonds, the commodity markets were also sending a clear signal.
What were they telling us?
They were basically confirming the market's sudden embrace of the Goldilocks scenario, not too hot, not too cold. How? By shedding hedges against both inflation and crisis simultaneously.
Okay, break that down. Which commodities?
Gold, the classic inflation and chaos hedge, it dropped 0.43% to around $4,188 an ounce. That's a significant pullback from its recent all-time high near $4,382.
And oil.
WTI crude oil futures also fell, settling down 0.34% at $61.58 a barrel.
So the market is saying, in effect, we're less worried about inflation, hence selling gold, and we're less worried about geopolitical crises or a deep recession, hence selling oil and gold.
Exactly. It's a double dose of risk-on signaling. Gold's drop was linked to both the cooling CPI and reports of that potential Trump-Xi meeting, which eased geopolitical concerns. So investors dumped their inflation hedge and their crisis hedge on the same day.
And that drop in oil has immediate consequences for specific stocks, right? WTI crude is now down significantly year over year.
Down 14.21% year over year. That creates a massive headwind for the energy sector's profits. And we saw that play out directly on Friday. ExxonMobil and Chevron were among the biggest S&P 500 laggards, falling sharply before their earnings reports next week.
So the macro commodity move is already hitting specific company valuations.
The market is pricing in that pain, anticipating weaker earnings and margins for the energy giants because of lower oil prices. It confirms the rotation out of that sector.
Okay, the stage is set. A euphoric market, priced for perfection, ignoring some warning signs, rotating aggressively into growth. Now we have to look ahead to this absolute gauntlet of a week coming up October 28th to 31st, because this entire fragile narrative is about to get stress-tested hard by earnings, by the Fed.
And the reality check started immediately, didn't even wait for Monday. Friday's after-hours trading session showed this profound, almost violent split between the macro optimism and the micro company-level reality.
Right. During the day, the macro story CPI miss, Fed pivot hopes lifted almost everything. But after the bell, micro news company earnings took over, and it proved that this rising tide of hope will definitely not lift all boats, especially not those tied closely to the consumer.
We saw a really clear divergence. On the positive side, the semiconductor story got a huge boost. Intel INTC surged after hours, up a massive, 8.44% to $41.38.
Why the big jump for Intel?
They reported earnings and swung to a surprise profit. Wall Street was expecting a loss, around negative 11 cents per share. They crushed that. So this fundamentally validates the whole tech and chip rally we saw during the day. Intel showed the AI and tech investments are translating into actual profits right now.
Okay, so confirmation on the tech side.
Oh, yeah.
But the consumer side looked ugly.
Brutal is maybe a better word. Deckers Outdoor, DECK, they own brands like HOKA and UGG. They had already plunged over 12% during their regular session.
And then after hours?
Down another 11.99%, a total drubbing, nearly 25% wiped out in a day. That signals profound weakness, or at least market fear about weakness, in a key consumer discretionary area. Analysts immediately pointed to worries about inventories, slowing orders.
And it wasn't just Deckers, right? Newmont Mining.
Newmont Corp, NEM, the big gold miner. It dropped another 6.89% after hours. That directly mirrors the slide in gold prices earlier, shows that commodity weakness is flowing straight through to the producer stocks.
So the market seems willing to overlook consumer pain, commodity weakness, as long as a core AI tech story delivers like Intel did. But that puts enormous pressure on the main event this week, the FOMC meeting, October 28th and 29th.
This is the #1 policy risk right now. As we've established, the market is fully pricing in that 25 basis point cut. But because it's fully baked in, the real danger isn't that they don't cut. The real danger is what we call a hawkish cut.
I get the fear of a hawkish cut, but let me push back slightly. Given the market is celebrating the VIX got crushed, is the Fed really going to risk triggering a crash just to sound tough on 3.0% inflation? Doesn't history show they often kind of validate strong market expectations like this?
That's the absolute core tension. You're right, the Fed knows the market is potentially fragile, but they also have their mandate price stability and maximum employment, and their official inflation target is 2.0%, not 3.0%.
So how does a hawkish cut actually play out?
Okay, it looks like this. The Fed delivers the 25 basis point cut. That satisfies the market's immediate demand, avoids an outright panic. But then, during the press conference, Fed Chair Powell really emphasizes that inflation at 3.0% is still unacceptably high. He might warn against assuming this is the start of a long easing cycle.
So it's not the action itself, it's the language. The forward guidance or lack thereof.
Precisely. The market isn't just priced for a cut, it's priced for an easing cycle, with more cuts expected well into, say, 2026. If Powell frames this cut as just a one-time adjustment or maybe a technical calibration rather than the start of that cycle,
the market reaction could be fiercely negative. It pulls a rug out from under the whole justification for the current rally.
Exactly. The foundation of this recent euphoria could just dissolve if the language is sufficiently hawkish, even with the cut delivered.
Okay, so navigate the Fed. If we get through that, we slam right into peak earnings season. The second huge risk factor, the price of perfection.
And the stakes here are just enormous. This coming week is the absolute peak. 175 S&P 500 companies reporting. And you have to look at the valuation context. The S&P 500 is trading at a forward price-to-earnings ratio of, what, 22.7?
22.7. That sounds high. What's the average?
The 10-year average is around 18.6, so we're paying a massive premium right now, nearly 22% above the historical average valuation to own these stocks.
We're literally paying for perfection, which means the bar for corporate earnings must be incredibly high. What do companies actually need to do to justify these levels?
Just beating the consensus earnings per share, or EPS, estimate, that's now just table stakes. It's the bare minimum. And even that stuff we've already seen, amazingly, 87.4% of companies that reported so far beat EPS estimates.
So a simple beat isn't enough anymore.
Not at a 22.7 PE. To justify these valuations, companies really need to hit a trifecta. One, they have to crush the EPS estimate, not just squeak by. Two, they need to beat revenue estimates, showing strong top-line demand is still there. And three, critically, they absolutely must raise their forward guidance for Q4 into next year.
If they beat on earnings, but sound cautious about the future,
The market will likely punish them severely. Just look at what happened to Deckers in after-hours trading. That was probably guidance-related fear.
and the outcome of this whole rally seems to rest disproportionately on the big tech names reporting this week, the Magnificent Seven.
Heavily. Their results need to be incredibly strong, probably even stronger than Intel's surprise, to offset any potential weakness we see from more consumer-facing or industrial companies. The pressure is immense.
So who do we have reporting and when?
Okay, Wednesday is colossal. We get Microsoft, MSFT, Alphabet, GeoGL, and Meta Platforms. Meta, that's cloud, AI infrastructure, digital advertising, the core engines. Any sign of slowing momentum there could ripple through the whole tech sector's valuation.
Wow, okay, and Thursday.
Thursday brings Amazon, AMZN, for e-commerce and cloud, Apple, AAPL, for consumer devices and services. Plus, you have healthcare giant Eli Lilly, LLY, and payments network MasterCard, MA. It's a huge cross-section.
So Amazon could confirm or deny the Decker's consumer weakness signal. Apple tests consumer resilience.
Exactly. And then Friday, we wrap up with the energy giants, ExxonMobil, XOM, and Chevron, CVX. And as we discussed, they're reporting right into that headwind of falling oil prices. It is an absolute earnings gauntlet.
And just when you think the week's risks are over, there's one final potential landmine. The economic spoiler risk on Friday, October 31st.
This is the sleeper threat. The data point the market seems to have completely tuned out because it's so fixated on the Fed meeting and the headline CPI number we already got. Friday brings the Employment Cost Index, or ECI, for the third quarter of 2025.
The ECI. Why is that number so important? Isn't CPI the main inflation gauge?
For the markets, maybe recently. But for the Fed, the ECI is arguably more critical right now. It's their preferred measure of wage inflation.
Why does wage inflation matter more to the Fed than the goods and services inflation in the CPI?
Because CPI inflation, especially for goods, can be quite sensitive to interest rates, supply chain fixes, things like that. It can come down relatively quickly. Wage inflation, measured by the ECI, tends to be much, much stickier.
Once wages go up, they rarely come back down.
Exactly. Rising wages create persistent demand in the economy and fuel that underlying structural inflation that's much harder for the Fed to control with just rate hikes. So if Friday's ECI comes in hot, showing wage growth is accelerating or staying stubbornly high,
That directly contradicts the market's whole inflation is beaten, time to cut rates narrative.
completely, it creates an immediate conflict. Even if the Fed does cut rates on Wednesday, a hot ECI number on Friday tells them, whoa, underlying wage pressures are still building. We probably can't afford to ease much more.
So a hot ECI, regardless of the FOMC decision earlier in the week, could just instantly unwind all those expectations for future cuts, the ones priced in for 2026.
It absolutely could. That single data point has the power to shatter the price for perfection narrative by reminding everyone that the Fed's primary inflation concern, sticky wages, might not be solved at all.
Okay, so let's pull this all together. We've dived deep into this record-setting rally. What does it all mean for you, the listener, as we head into November?
We saw this powerful, undeniable market surge, euphoria, really, fueled by that tiny CPI miss, confirmed by falling bond yields, driving a huge rotation into growth stocks like semiconductors.
But, and this is a huge but, this euphoria feels incredibly fragile. It exists alongside some really worrying signs. That dual-track market with quality and junk soaring together. the market deliberately ignoring strong forward data like the PMI, and the swift, brutal punishment for any company showing consumer weakness like Decker's.
And the week ahead is just loaded with risk. Policy risk with the FOMC, where even getting the expected cut might not be enough if the Fed's language is hawkish. And huge execution risk with peak earnings season, especially with valuations stretched so thin at that 22.7 PE ratio. So the CPI report gave the market the justification it craved to believe the Fed will pivot and start easing. But here's the final provocative thought for you to mull over as we go into this critical week. The market's celebrating disinflation in goods and services based on that backward-looking CPI.
But the real test of the Fed's future path, the thing that might dictate policy for months to come, could lie in the data the market's currently ignoring, the stickiness of wage inflation measured by the ECI.
We've seen the market celebrate the past via CPI. If the market is truly priced for a whole cycle of cuts based on that rearview mirror data, what happens when the forward-looking employment cost index lands on Friday?
Which inflation number ultimately wins? The one the market chose to love this week or the one the Fed truly fears? That conflict, right there, is where the next deep dive into market stability really begins.